Taking us to the closing bell are Brad McMillan, CIO for Commonwealth Financial, as well as Steven Blitz, U.S. economist at TS Lombard. Brad, really quick, as we head toward the end of the year, we're watching some downside in the market today. Is it the concern about unemployment and where we still stand with COVID?
Everything's going wrong right now. We've got COVID, we've got unemployment, we've got uncertainty about the stimulus. There's just a lot to worry about at the moment, and that's what we're seeing.
Steve, what's on your radar just as you see the reaction in the market today to some of those increased restrictions that we're seeing because of COVID? Dow off 165. What's your outlook?
I think there'll be knockdowns, obviously, close downs to some extent. I don't think they're going to be anything like March or April. There's no reason for it. And the other thing I'll say is I never trust a December market for having tremendous meaning going to the next year. Year-end window dressing, thinner liquidity, taxes, all sorts of things can, move the market. So I'm not sure that there's any real trend to decipher here. I think it's a market move, and everyone's looking for a reason.
All right, let's bring Inez Ferrer in. We have roughly a minute and 20 seconds to the closing bell. And one thing, Inez, we're watching some sectors which last week had been doing pretty well. For instance, energy, it was doing well over the past couple of weeks, but today, not so much. What have you got for us as we head towards that closing bell, Inez?
That's right. Looking at the sector action, we're seeing that energy and industrials lagging right now. You've got communication services or technology and consumer discretionary, rather. Those are in the green. It looks like we're going to be closing with mixed markets, with the Dow down about 130 points off its intraday highs from earlier this morning. Earlier this morning, the Dow was up about 200 points. Just looking at some of the Dow components, you can see that Disney down more than 3%, Chevron down more than 3%. And then looking we're on the NASDAQ, Tesla up about 5%, Netflix up about 4%, Netflix fending off adaptive streaming's patent infringement suit through an appeals win. And looking at the travel stocks, those are ending the session mostly in the red. You've got United Airlines, some of the cruise liners also in red territory as we go into the closing bells. And the semis is in the green. Here's the closing bell.
And that does it for the trading day today. Again, you can see a mixed picture with the Dow closing off the lows of the day, although it looks like actually we just took a leg lower here in the final couple of seconds of trading. So Dow closing off 186, right around the lows of the day. S&P also in the red, off nearly 0.5%. The NASDAQ, though, holding on to gains today, and you can see that reflected in the sector action. Technology is one of the sectors here holding on to gains, as well as consumer discretionary. On the flip side, like what Adam was saying earlier, energy, financials, and industrials, the sectors that have been outperforming over the last couple of weeks, coming under a bit of pressure today, with all three of those sectors ending in the red. In terms of the Dow, we're seeing the biggest weakness in Disney and Chevron. Those two stocks are the worst performers in the Dow today. Brad, I want to bring you back in just in terms of as we look ahead to next year, to 2021, we've seen a bit of this rotation from growth to value. Are you confident that that trend, that this rotation in terms of what's leading us higher is going to stick next year?
I do think value is going to outperform going forward. And I think it's all about interest rates. We've seen growth stocks outperform as interest rates have gone down. That's just because on a dividend discount model, future earnings are larger and they're worth more as rates go down. But once rates actually flatten out or even start to go up a bit, that tailwind turns into a headwind. And when you look at how beaten down value stocks have been, I think there's a real opportunity there going forward.
Stephen, based on what we just heard him say, when you look at what the Fed's about to do, what is the challenge for them to convince Wall Street that they don't have to worry about that headline for another year or two?
Yeah, I think as the year goes on, obviously, the Fed, just like the economy, has two challenges, right? So the near-term challenge for the Fed is simply that as we go through this slow patch in the economy over the next several months, that everyone knows that they're there, and I think everybody does. So I think getting to the second half of the year, vaccines, things open up, and off we go. I think the Fed's real problem is going to be convincing the market that they're really going to keep the funds rate at zero for several years while waiting for this still unquantified employment target is reached. Because as you get towards the end of the year, look, the Fed's probably going to be backing off a little bit on its balance sheet increases and probably may not be adding at all by the time you get to a year from now. But in order to keep the market itself from looking at that and tightening financial conditions, they're going to have to extend the maturity of the balance sheet, which just is another way of saying yield curve control.
Hey, Brad, in your recent notes, you mentioned the jobs market and consumer confidence, both of those holding up surprisingly well. We have seen, though, job growth beginning to slow, consumer confidence also slipping a bit. How big of a risk do you see this potentially posing to the market?
Well, the question is how much damage is done over the next couple of months? Okay, as I said earlier, we're hitting the darkest part. I mean, winter is here, but spring is coming. So how much damage gets done before the spring? I mean, that's why we need a federal stimulus program to mitigate that damage. But then let's take a step back and look at a little bit of context. Yes, job growth was down significantly, but is still well above, more than twice what it was before we moved into the pandemic. So the healing continues despite everything. And the question is, are things going to get worse or better from here? I think they're going to get better. We're going to see job growth come back. But if it doesn't, if the damage over the next month or two knocks that off, along with confidence, that's when we start to really see the risks rise. But we're not there. I don't think we're going to be.
Well, if you're optimistic and you see a return to normal by the end of 2021, Brad, I'm curious which sectors in this new environment, because COVID has changed a lot of things. I mean, we talk a lot about energy. Nobody's really expecting energy, when I talk energy, I'm talking oil and gas, to be the huge players that it has been in the past. So which sectors benefit?
I actually think energy has been sold off too early. Because look at it this way. If people start driving again, I don't drive. I fill my tank up every month, maybe every 6 weeks. If I go back to filling it up every week or two, that's going to triple my demand for gas. And at the same time, we've seen supply start to knock down as companies have stopped investing. I think it's too early to write off energy. And then we talked about consumer discretionary today. People are not spending money. People have put their savings up substantially. They're going to want to spend that money next year when they can, when they feel good. I think we're going to have a consumer spending boom at some point next year, and it's not too soon to start thinking about that.
I think one of the figures we keep hearing is 1.4 trillion off to the side, ironically the same amount that apparently is being negotiated for a future stimulus. Brad McMillan, CIO for Commonwealth Financial, and Steven Blitz, U.S. economist at TS Lombard. Thank you both for joining us.